Whether you're for or against participation in the European Union, a get-tough approach to financial regulation is shared across the continent. Here to discuss how effective regulators, governments, and multinational corporations have been, Nick Jeffrey, Grant Thornton International, Marian Williams, FRC, and finally Raj Thamotheram, visiting fellow at the Smith School of Enterprise and the Environment at the University of Oxford. Before we begin our conversation, let's familiarize ourselves with the growing complexity of financial regulation.
Stakeholders in Europe's largest corporations are calling for greater disclosure and transparency in financial reports. This appetite for change is a challenge for regulators, which are struggling to balance stringent policy with maintaining a competitive marketplace. The most dramatic move to regulatory convergence comes from the European Parliament. This year it committed more than €7.5 million to the International Financial Reporting Standards Foundation and the European Financial Reporting Advisory Group, reaffirming the Commission's interests in achieving truly international accounting standards.
Now, the move towards greater regulatory harmonization has been shared by most, but do you think this is even a feasible plan?
Ideally, we'd like to see regulation harmonised across the world, ideally. But that's a little bit of a nirvana that we're never really going to get. There's too many barriers in the way of that. You're never going to get international rules across the board. We would like to see regulators continue to talk with each other, exchanging their views on the problems that they're facing, that investors want them to address, and to have a consistency as far as possible across the world.
Marian?
I would completely agree with Nick. Utopia isn't achievable, at least in our lifetime. I think what we do at the Financial Reporting Council, we work alongside the PRA, the FCA, obviously our counterparts both in the European Union and across the world in terms of getting a better regulation. As the regulator responsible for reporting and auditing in the UK, clearly our remit is quite wide. And also at the same time, we set the codes and standards for reporting in the UK. So trying to get working across all of those areas is challenging, but that's something we seek to do.
Okay. Raj?
With the best will in the world, regulators, and indeed all of us, are a little bit like the generals fighting the last war. Back in the 70s, something like 80% of a company's assets were due to the finances and the physical assets. Today, that's probably down to 20%. The stuff that matters are the non-financial assets, and that's the key game in town. It's the human capital, it's the corporate culture, it's the governance, it's the behavioural governance, it's the R&D, it's the innovation. The really big challenge today is how to get harmonisation of that kind of reporting, because that's how we can look forward.
Now, looking at harmonization, first let's talk about what needs to be disclosed in financial reports. Let's consider the repatriation of funds. Do you think that information needs to be included in financial reports when it's involving European companies? Marian?
So essentially in our strategic report, which was introduced at the beginning of this year, you would expect such challenges or such information to be part of what a company should disclose to its investors, because clearly that is a part of what will help investors decide if they want to invest or if they want to take their money from that company. So I think if something is clearly material, then that should be disclosed in the financial statements.
Okay, now let's talk about the takeover panel. For instance, you are tasked with looking out for the public's interest. Do you think that if there is a multinational takeover bid, that your organization anyway should be involved in that process? Perhaps your remit might be too narrow in focus right now.
At the moment, the FRC does not have a role on takeovers as such, but we're responsible for the issuance of the stewardship code, which was issued 2 years ago, and we review it every 2 years. And that was really about promotion of the long-term interests of companies via the investors. So in a takeover situation, you've got a very delicate balance between who's investing for the long term and who's investing for the short term. And that's quite a challenge to understand how the stewardship code should apply.
Nick, what do you think the stewardship code?
I think the stewardship code came around as a reflection that companies and their owners were not talking together. In some ways, they were talking past each other. That in itself was a reflection that periodically a company would produce 500 or 600 pages, as you were referring to. And there'd be this whole raft of information appear, and investors were saying, what am I supposed to do with this? The strategic report that Marian was referring to, I'm a strong supporter of that. What that's intended to do is to kind of stratify the information to give everybody the same amount of information if they want it, but direct different users of financial reports and annual reports, as Raj was referring to a different degree of granularity depending on what they want and what they need.
In its current form, then, do you think it's taking in all of those financial and non-financial factors that you've written about extensively, Raj?
The intent is absolutely right, and the encouragement from the FRC and government to greater stewardship is absolutely the way to go, but I think there's a little bit more box ticking than substance at the moment today. So if you look just at the issue of mergers and acquisitions, what we see is very low transparency on the part of investors on the reporting of how they actually deal with it. I looked at 4 investors who are at the top of the field, and actually to get the data of how they were voting took the best part of my research of one whole day to be able to compare just those 4 investors. What we found was that actually the vote against mergers and acquisitions went from 0.5% to 50%. There is some reason for this huge difference, and I think part of it is that actually the system isn't working in terms of shining light on the key factors that investors should consider.
Marian, would the system work better now that we have the ISB as well as the FASB working towards convergence in standards?
The recent revenue recognition standard that was issued by FASB and ISB was around getting one standard that could be implemented globally, which looks at reporting of how revenue should be reported. I think that's a very positive move, and we feel it's something that we've worked closely with the ISB on all their projects, this one included. So getting a standard that can allow consistency, comparativity across the world is very positive. However, this has only just been really introduced, so it's probably too early to tell whether we can raise the flag of success, if you like.
But just the sheer fact that we have these convergent standards demonstrates that at the international level there is coordination that's happening. Do we even need the government to be involved in financial regulation?
We definitely need the likes of the FRC. We definitely need audit regulators. And that was brought around at a time in the history of financial and corporate reporting when investor confidence had taken a knock. Since the FRC and others have been cooperating at the international level, that has reinforced investor confidence in financial information. We're very close in the next maybe 5 years to approaching the point of diminishing returns. The point that Raj is making about wider information about a business, not just the numbers, but wider information about intangibles. Think about Grant Thornton's business. Our two main assets are our brand and our people.
Raj, do you think that we can trust companies to self-regulate?
The thing is, you can trust most people to do the right thing, but you can't trust the people who can't be trusted. And that's where the role of the regulator is important, to make sure that there is a policing mechanism. I think Ronald Reagan said, trust but verify. We need that backstop in order for the voluntary system to work well. The bit that it's not working well on, and this is the challenge looking forward, is that the things that are really important to assess a company going forward, the CapEx, the return on invested capital, the human capital, the staff engagement, these things are currently very badly reported. This is why we need government intervention to turn up the dial and make sure we start to deliver on what we need to be delivering.
Okay, did you want to add
If I can just disagree if I can on that point. I agree with the point about giving more information where it's relevant. I think the word relevance is really important to emphasise. Human capital, for instance, at the Financial Reporting Council really wouldn't make very interesting reading, but it may do at another organisation. So I think it's really in my view, in our view, it would be very difficult to police non-financial reporting. However, I think what companies should be doing is liaising with their investors as to what is relevant. If it's British Airways and its carbon emissions, or hotels and its occupancy, then that's probably, it will stick more if investors really want it.
Nick?
The strategic report, what that does really well, the UK government's done really well, is it's given a framework of high-level minimum requirements that allows companies that want or need to do this sort of reporting in reacting to what their stakeholders want. I think you've got to be very careful when you're talking about government stepping in to start setting reporting requirements in the non-financial area, because I think what we really need here is innovation. And to my mind, we haven't heard enough from investors and other stakeholders about why human capital is so important to them.
Well, we liaise with NGOs on what is important to them, and I think they have, we have listened to them and they value us listening to them. But I agree with Nick in terms of it needs to be relevant. It should sit possibly in the strategic report, but then if companies want to give more information because their investors want it, then it should probably sit on their website. So there is opportunity for companies to give more, but it may not sit in the annual report.
I had a chance to speak with a small firm that was fined for falling under national accounting standards. Here's what they had to say about the current state of financial regulation in the UK. The number of high-profile cases coming to light is not resulting in the level of sanction that the public might expect. This is partly because big firms have deep pockets and audit work requires judgment to be exercised by human beings. FRC, let me first pose a question to you. How do you expect these various groups to be able to keep up with the ever-changing nature of financial regulation?
I think it is more challenging, clearly, for the smaller firms to keep up with financial regulation. But if you're in the business of giving accounting or being an audit firm, there are some requirements that you must comply with in order to meet those standards. And the FRC's role is to make sure that they are behaving appropriately. Just in terms of the cases and specifically the larger firms, at the moment we're looking at about 20 investigations. Of those 20, about half of them are actually referenced to larger firms. You've probably heard of most recently the Rover case, which, although it's subject to appeal, the tribunal came up with a figure of 14 million against Deloitte. So the land has probably changed here. I think we're looking through our processes to make them more efficient post-reform.
Nick?
I think the complexity issue, I'm afraid I'm not terribly impressed by that argument. If that's the field we're playing in, you've got to deal with that issue, and you've got to be prepared. If you want to work for large corporates, you've got to be prepared to deal with it.
Now, there are other means of policing. Of course, the European Parliament voted to force companies to hire new auditors at 10 to 24-year intervals to reduce the excessive familiarity between statutory auditors. What do you make of that, Nick? Do you think that is actually going to be achieved through this rotation process?
I think the environment that we're now living in, audit is no longer a job for life. And by the same token, you don't give loads of other services to a big company's auditor. The idea of changing your auditor every 2 or 3 years would be harmful to quality, but changing them periodically, I think really as a market we ought to be able to cope with that. And I think it's a good development. The package of measures that's come out of Europe is well balanced. It's not focused on one particular issue, and it reflects the investor sentiment that's been happening in the market. They don't like lots of non-audit services going to the auditor. They don't like audit being a job for life. They want periodic challenge.
Okay, Raj?
The connection which Nick made, I think, is terribly important. The purpose of the audit is primarily for the investors. It is a mechanism to reassure the investors that the financial accounts and the other statements are true and fair. A due process of renewal of that contract allows for the prevention of capture of interest by personal relationships and other factors. And so it's the connection with the trust that we spoke about. We know we need to reestablish why that's so important today, I think.
And what does that do to monopoly that maybe the big four currently have in the industry? Nick, what does that do, when you have audit rotation? Does this level out the playing field?
There are things that the FRC and other audit regulators can do to make sure that there is a level playing field. They can make sure that where appropriate they're comparing audit firms that do the similar sorts of work. They're not comparing apples with oranges. They can publish named reports on individual firms, which the FRC has done for a while now, and that's extremely helpful to investor confidence. When they publish those reports, they can publish them at the same time, so we're not comparing one firm's recent report with another firm's old report. There's a bit that the regulators can do. I have to say the FRC is probably one of the better in the world at doing these sorts of things. I think the FRC can still be better.
So just on the point, and I think Nick's point is fair, and we publish the audit quality reports for each of the big four on an annual basis. In fact, it was released last week. And on Grant Thornton BDO, we publish those every 2 years. Now we'll be looking to publish that annually. So I think the point is well made.
Raj, do you think that's enough?
The ecosystem of players is the critical issue, and I think it's not just auditors that can keep companies on the true path, it's also investors. This is where the regulatory bodies, not just the FRC, could perhaps step up. For example, let's go back to the merger and acquisition example again. We know all the data suggests that something like only 13% or 17% of mergers and acquisitions deliver the value that they're stated to deliver. Today, there is no requirement for investors to report on why they voted in the way they did. Now, the FRC could, in fact, ask investors to explain how they're tracking that reporting, what they're learning from it. This wouldn't be micromanaging. It would just be asking another aspect of the value-adding function. Now, that then creates space for the auditors to do their job better because there's another player in the game having some insight. It's very hard for auditors to challenge their sort of fee-paying client on some very sensitive issues. So I think it's an ecosystem.
Do you think that we have seen a maturation of the financial reporting community in terms of, I mean, even if we look back to 1970s where we had the Nestle baby milk scandal, which everyone is aware of, in the aftermath of that scandal, we saw the many indices that came to birth, including the FTSE for Good index, reporting on what people wanted to know in terms of those investors who were looking for that additional information, as you mentioned. But how does an organization such as the FRC or another one then say, let's look at this index versus another? How do you measure the merits, Raj?
I fully agree that regulators can't micromanage companies and tell companies what to report. But I think there are some areas where the gaps have been so consistent and so long-lasting. I can go back to human capital, for example. Say, for example, we're invested in 2 retail companies, and a retail company changes its management and starts to lose the engagement of its staff and starts to have a staff turnover. We know that that's a lead indicator of risk, but currently there's no requirement to report on that. So unless investors have a consistent reporting on some standards, the system won't take it into account. It's not possible for passive investors to take a little bit of data here, but if there's no data here, can I compare it? So I think there's a leveling that regulators need to do around material issues. And it's happening, but it's happening a little bit too slowly.
Nick, you have an intimate understanding, of course, being on the front lines of auditing accounting standards and what your clients are willing to apply. Corporate governance, how important is it really to them?
It's part of the mosaic that helps to bring the whole thing together. Just to go back on something that Raj was saying, I think we're arguing about shades of grey. I think, Raj seems to be towards the end of the spectrum where he wants more impetus because companies aren't doing what investors need now. I'm slightly the other way. I would say that for investors to drive their information needs and not to rely on governments too much. I think for me, it's for investors to be more vocal about what they want to know about sales per square metre or staff turnover. It's for them to be more vocal about the things that drive their investment decisions.
What do you make of this criticism? Do you think that the FRC, other regulatory bodies, have shouldered enough of a burden and taken action as a result?
I think the strategic report is a good example where companies have to give their details of their principal risks, and therefore in this situation companies should be providing the information that is important for shareholders, that is relevant. We just need to watch the amount of information. And project just launched this morning actually was our Clear and Concise project, where we're looking at what is relevant to stakeholders and investors. And I think we're all saying the same thing, I think really, is what is really relevant to investors and to retailers, for instance. Clearly, if one starts giving profit per square foot, then that might make the other provide that information too. So I think if you see some leadership in that particular topic or in that area, then you might find others follow. But I don't think really it is for the regulator in this instance for non-financial reporting, because as I said, it's a very deep ocean. I think we'd be drowning.
I think you would get a faster reaction if you leave regulation to one side and let the market innovate. And if you let the market react to what investors are asking or to what competitors are giving.
That actually is happening, which is great. The European context, the European Federation of Analytical Societies, FS, is encouraging standardized disclosure on ESG issues. And in America, Michael Bloomberg and Mary Shapiro have just joined the Sustainability Accounting Standards Board, which is doing the same. The challenge there is that we're going to fall back again into that FASB, IASB divergence, and then we're going to have to knit this thing together. So the trick, I think, is to do the learning from the last experience ahead of time and try and create a convergence standard. What's, I think, really exciting is the Sustainable Stock Exchange Initiative, which potentially allows many stock exchanges to move in the right direction. We are definitely arguing about gradations, but it's for me, it's not an either-or situation. Everyone needs to be in the game.
In terms of financial reporting, where would you say you would add more information related to how to enhance investor relationships or pull back?
I suppose I'd look at the characteristics really. So I think materiality, clearly, if it's material to a user of a financial statements, that must be in. It must be relevant, but at the same time, it must be concise. So you're trying to balance the two, which is really challenging.
But when we're looking at 400, 500 pages of reporting, while the intention might be right, do you think that the European shareholder going to sit and read through every single page of that report, or only focus on what's key? And should the rules and regulations as to what's being reported in the basic report, should that be changed faster?
You know, your challenge is fair, and I think there's probably something to think about innovation. Nick mentioned earlier around, you know, how can companies get possibly more smart with where they put their information? There may be something to think about there. For instance, we're looking at a new project on reporting in a digital world. So maybe there's something there around how companies, not what they report, is where they report it and how they report it.
I think that's where the potential of kind of collaborative action between regulators and investors could be really potent, because the great thing about investors is by consensus they can define a set of standards and criteria with companies on what's most material, and that being not regulated can evolve every 2 or 3 years as understanding evolves. And I think there's a real potential here between what regulators can do and what investors can do. I just want to challenge us, though. We used your phrase non-financial, but you know, when you look at Lehman's or BP or Rentokil or Parmalat or Vivendi or WorldCom, to call these things non-financial misses the strategic importance of them. And I think that's what we're continuing to do sometimes, to miss the strategic importance of these super financial, extra financial, whatever we call these things. Now, how to capture that, I think, is the challenge for both regulators and investors, supported by auditors. So I think you've framed the discussion extremely well.
But I think what we also need to consider is that there are people there are companies rather, that are doing this well. You work with some of them. Can you tell me who is doing this well? Who is incorporating this information, if you want to use a term other than non-financial?
You know, a company like Unilever is well experienced, and not just for PR reasons, but over a long period of time, at integrating into all aspects of its strategy planning and its remuneration design long-term incentives to take into account these sustainability factors. So the current CEO came in with a desire to double his financial targets and halve his carbon footprint. Not a trade-off either, a win-win. That's not yet the norm. And I think that's our challenge, because that's what society needs us to do. We need to rapidly move to greater eco-resources efficiency, better organisational kind of governance, behavioural governance cultures, and a more empowered and engaged workforce. Stellar examples exist. Now we need to move it into the norm of practice.
Grant Thornton must work with some big names out there. Is there an appetite for change similar to what Raj has been discussing?
We react to the pressures that are in our environment. And I think we as a profession could be smarter and stronger in advising the companies that we work with and the investors that we work for, to help them understand what is really material to the users of their information, if I can put it like that, the information that goes out there, not to just put everything out there in reaction to what they think a regulator might react to. We've got to be stronger in saying to our companies that we audit, you don't need that bit of information, it's not material to users. And we need to be stronger in saying that to regulators when they come in and rightly challenge us on that. We say, it's not material.
Well, it sounds like the innovations really have to take place at various levels, not just at the regulatory level, but even in the way that companies perceive their role in this world and their long-term interests. Well, Nick, Marian, Raj, thank you so much for joining us today. Now, have financial regulators and governments done enough in policing this industry? Tweet us your thoughts at World Finance, and remember to hashtag financial reporting.